This video will be an analysis of both Q2 and Q3 financial quarters of Crocs stock, with my personal twist of humor. If you want to skip through the jokes, feel free to use the chapters to skip to the part of my real analysis, but I warn you, there's jokes throughout. As for the rest of you, here we go. Bro, turn on the news.
Okay, sure.
Croc stock.
Are you ready, Ski Dad? It's time for the light round clears. Everybody start with Brandon in New Jersey. Brandon.
They raised their full year operating margins, their guidance, their EPS, and for the first time they hit the record of $1 billion in revenue. It seems like HeyDude is slowing down. What if everything is wrong? What if I buy the dip and it keeps dipping?
I want to feel like it's raining on me, okay?
And now for our feature presentation.
Fashion. Innovation. Disruption. What if you could find an investment that could encompass the cutting edge of human ingenuity? And I know what you're thinking. No, I'm not describing the new Tesla self-driving shoes. This is a fashion trend more revolutionary than that, that's taking the world by storm. Suit and tie? What are you, 12? Yeezys? Do you want to invest in peak fashion? The type of fashion where if you meet your girlfriend's parents for the first time, the father will beg you to marry his daughter because he saw you wearing these? Well, look no further than Crocs. Crocs. This over here, this is a brand with global presence whose share price appreciated 600% in the last 5 years. It's a company that's trading at less than 10 times earnings right now, with high free cash flow and margins and record revenue. But on the other hand, this is a company that may have run its course. It's a company that many consider to be a fad. It's a company that people say has already oversaturated the market. And besides, this is a retailer with a lot of debt. Maybe, just maybe, it's time for Crocs to... Hey guys, this is Financial Freedom with Dennis. So, Crocs stock, let's go ahead and talk about that. My style of investing, I don't really identify myself as a dividend investor, a growth investor, value investor. I don't really identify as any of those. For me, what I look for companies with great risk-adjusted returns, where I'm not necessarily taking a great amount of risk or low amount of risk. I'm just taking a reasonable amount of risk for market-beating returns. That's what I see in this company. I do want to mention Crocs' brand, HeyDude, is actually entering a partnership with my guests today. And they're entering a partnership with Dude Perfect.
Dennis?
Oh, dude!
Dude, what's up?
Hey, how's it going?
Grab your camera.
Wait, you wanna do the video right now? Guys, okay, we're gonna do a collab video with Dude Perfect. Alright, let's go. We are Dude Perfect. Get the football into the plate. Oh yeah, that was fun. So yeah, I'm really liking my investment in Crocs. I think the stock is just gonna keep on going up and up and up and up, and there's nothing that could possibly go wrong. Bro, yeah, I'm talking to you. Turn on the news.
Okay, sure. Yeah, sure. We can look at the news. You said
Crocs stock.
you heard something about Crocs? Okay.
And in shocking news today, it has been revealed that
Charlie Munger,
does not approve of Warren Buffett wearing Crocs. The stock now sucks, and Crocs is just a fad.
Well, it's gone.
What? The stock crashed 20%. Oh no, what if everything is wrong? What if I buy the dip and it keeps dipping? Oh no, I have to do research. No.
Are you ready, ski daddy? Time for the light round clears. Everybody start with Brandon in New Jersey. Brandon.
So I saw some insider buying on Croc stock, and I was wondering what you thought about it.
I like Crocs, but I worry about the fat aspect and one day coming in, seeing it down too low. So I'm going to take a pass on it.
Phew. I'm glad Jim Cramer doesn't like Croc stock. I feel better now. I think that's enough research for today. We can do more research tomorrow. Today's a new day. I can't believe I was so scared of Croc stock dropping, especially considering how I'm Wall Street's top analyst. I should show some of my top tier research. Let's review the Crocs investment thesis.
Crocs made cowboy boots with real spurs, and I got them, so I had to see how these worked. Now the box they come in is massive, and when you open it up, you get the boots. Now it looks like these spurs are actually their own set of gibbets. The only logical thing left to do was to test out those spurs, and these things did not disappoint.
I don't need it. I don't need it. I definitely don't need it. I 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 need it!
Okay, maybe that was a bit of an exaggeration, but this has always been part of my bull thesis.
Just got these new AirPods.
What AirPods?
Man, hold on, cause she thought I wasn't wearing Crocs. Hold on. Get these like that.
What are those?
They are my Crocs.
Dennis, honey,
Shrek
did
Crocs
you clean
are
your
real,
room?
and I got
Not
them,
now,
but they're
Mom.
worth
I'm
all
doing
the
stock
money.
research.
Shrek with the ears and nose.
And stock research he did, as he continued to uselessly scroll through TikTok and YouTube Finance as if this was some form of financial education. Little did Dennis know his lame attempt at a funny stock analysis video would actually become a real analysis video. Dennis slowly made his way to his recording studio, armed with his newfound knowledge and his tiny fractional share of not even one Croc stock that is, sadly, actually a 2.5% allocation in his real portfolio, and he began to unironically share what little knowledge he had.
Alright, let's begin. So I should first disclose my position. My cost average is, $91.78. I'm currently up 17% as of December 16th, 2023. So this recording is going to be an analysis of both Q2 and Q3 of 2023. So you get a 2-for-1. So pay attention to this area of the screen over here. And that will tell you what quarter we're talking about. But I usually will start each section of the video with Q2 and then progress into Q3 if there's going to be any changes. Of course, I did not really mention anything about the Crocs bag. There's other items that Crocs does sell, and there's also gibbets, which I don't mention, but there's quite a bit of upside still. So ignoring those items, I'm going to address the main points in this video, which are going to be the bear cases. And I will do so through 3 different main sections. Objectively, the stock is cheap because the stock is pricing in a lot of failures. So us as investors, we're essentially asking ourselves, is this a value trap or is this an opportunity? Ultimately, for myself, I do not think this is a stock that I would be comfortable making a massive position. However, as I continue to watch the stock, I plan on averaging up or maybe even down, depending on how the story plays out. And honestly, if you were to come to me in a time machine and tell me that Crocs is not popular in 5 years, I'd be inclined to believe you. And on the other hand, if you were to tell me that Crocs is hugely popular, I would also be inclined to believe you. And for that reason, I personally am not going to make this a massive position. And as I continue to watch, I remain optimistic. So why did the stock drop? Well, the company released their Q2 2023 earnings, and it looked like a beautiful quarter actually. Management raised their outlook for almost all of their numbers. They raised their full-year operating margins, their guidance, their EPS, and for the first time, they hit the record of $1 billion in revenue. All right, thank you, Q2, Dennis. As for Q3, this is very much the same story. Crocs is also still making over $1 billion in revenue, so this is a record revenue quarter for Crocs. And with that, let's get on to the analysis of the 3 different bear cases. Bear thesis number 1, Crocs is a fad. So we did just have the COVID run up on a lot of these stocks and the subsequent COVID drop. Now the real question here is Crocs a company that was aided by COVID, or is this a company that can stand alone without the stimulus? So in order for us to find out, let's go ahead and crack into the data. Okay, so I want to bring us to a roadmap. This is an older document, so we're going to go ahead and ignore the left side of that, and let's focus on the restructuring of the business from 2014 to 2017. At this time, Crocs had overdone their stores. They opened too many stores. They were too inefficient, losing a lot of money. They weren't really capitalizing. They didn't really have a plan. So around 2014, they decided to rebrand their business. They ended up closing over 200 stores that were less profitable, keeping the more profitable stores open. And around this time, they also began strategic advertising, strategic partnerships with social media influencers. And that's why around 2018, Crocs really began achieving that double-digit growth, the operating margins, and they also began expanding globally. So notice what I said, the year is 2018 when this happened. This was already going on prior to when COVID hit and all the stimulus was being pumped into the market. Essentially, they were continuing their expansion plans as usual. They even aggressively bought back shares at this time period. But after all of that, in around 2022, early 2022, I believe it was February of 22, they acquired the HeyDude brand, and that caused them to rack up a lot of debt. So why am I telling you all this data? In real profitable investing, you can't just look at companies with low PE ratios and say, okay, let me use my 10 pillars and come up with you just plug in 12, 14, 16% growth. You can't do that. In order for you to plug in growth metrics into your analysis, you have to first understand the company. So essentially, the type of research that I do is I start with the quantitative research, then I move to qualitative again, and then finally close off with quantitative research yet again. And that allows me to understand the business, understand the numbers. And I think the bottom line here is people are selling off the stock because they are doubting the brand value of Crocs. They're doubting the moat of Crocs. And I know you can argue, okay, where's the moat, right? Crocs, the material is a proprietary material, so I mean, that's kind of like maybe not the best moat. And I really think the moat of Crocs is the brand value. Not the strongest moat, right? But a moat nonetheless. And the bottom line is, the company was already profitable and growing massively before COVID hit. So I want to pull in some more details. Now, I like to do this sometimes depending on the company. What I'm using is Google Trends. This is not anything revolutionary. A lot of people do this with their analysis. Some people don't think it's that helpful. For myself personally, I think it does help supplement the data. Let's take a look at Google Trends. I'm looking at the largest economies in the world, maybe like the top 5 or so large economies. We'll look at that. Let's see. So, of course, America, the growth is a little bit slower on the uptrend, but growth nonetheless. I have China, which is very difficult for me to show growth. I'm gonna show something else instead. We have in the investor presentation, we see that China revenues are growing quite quickly still. Probably gonna slow down because of the economic environment of China. We do see some strategic advertising, just as Crocs has been doing. So business as usual, in my opinion. Looking at Japan, another large economy, all-time highs. Germany, all-time highs. India, all-time highs. UK, all-time highs. France, all-time highs. The list goes on. Ultimately, I do not think that this is a COVID boom stock. In fact, through all their clever marketing, advertising, the management team has shown me that they're very competent. Before everything that happened, they were doing stock buybacks very aggressively. I'm going to talk more about that in the next segment. But overall, this is a company that has increased their EPS, their growth. I'm looking at an increase in their total revenue. And they even increased their guidance. Slide 28 over here. We see that their previous total revenue guidance was 11 to 14%, and that's been dragged up to 12.5 to 14.5%. So beating on all of their numbers and raising.
Wait a minute.
Okay, so last quarter they increased their guidance up to 12.5 to 14.5%, and now they're decreasing their guidance for Q3 to 10 to 11%. What exactly happened? Well, it's a combination of two things. The first thing, of course, is HeyDude. It seems like HeyDude is slowing down. Cool. We'll talk more about that in the HeyDude section. But another thing is, it seems like Crocs is executing their plan to cut out the gray market and their distribution partners. And what that means is, in the gray market, hypothetically, I'm going to come up with some hypothetical numbers. One company is selling Crocs' shoes for $49.99. And the original Crocs shoe sells for, let's say, $69.99. If Crocs and the other wholesaler are selling the same exact shoe on the same exact website, what Crocs, the original Crocs, will do is they will lower their prices to match whatever the wholesale distributor is selling it for. In other words, they're cutting into their margins. What Crocs is doing now is they're saying, okay, we're going to increase the price back up to $69.99. And what that's going to probably do is people are probably going to buy the cheaper shoe for $49.99, which will probably reduce some of their sales. This is a short-term issue, and that's likely something that may also be causing a hit to the revenue. And this is something that's happening for not just Crocs, the original shoe, but also for HeyDude. Again, we'll talk more about HeyDude. The main point of all this is all short-term pain. Once the distributors run out of shoes, they can no longer lowball Crocs.
Taking the environment aside, we made an important pivot to our digital pricing strategy in September. Specifically, we made the decision to stop price matching with the gray market goods that are selling on Amazon, forfeiting near-term sales to prioritize long-term market health. We know it's the right decision for the brand going forward.
So the bottom line here is, for the original Crocs shoe, the margins are going up, everything looks beautiful. Crocs has a lot of debt. Let's take a look at that. So they do address this in their investor presentation. Looking at slide 26, and they're talking about their debt to leverage ratios. They are significantly improving. Let's go ahead and see, let's fact check management and see if that is the case. So looking at the long-term debt here, it went all the way up to $3 billion after the HeyDude acquisition. And we're counting about, let's see, 1, 2, 3, 4, 5. So 5 quarters down, the debt goes from $3 billion to $2 billion. Literally, they paid off that much debt in 5 quarters, pretty much in 1 year. The management team actually has a target debt ratio that they want to hit. I'll show that on the screen right now. And essentially, how the question here as an investor is, how long will it take for Crocs to reach the safe level of debt again? And we just saw that they went from 3 to 2 billion in about 5 quarters. So I think it's safe to assume that while the company is even growing faster, within about another year or so, the debt should be manageable from 2 billion back down. And at around that time, I'm assuming the market's going to realize, oh wait, the debt is actually not that big of a deal. Maybe this stock is not in trouble. We may see some share price appreciation just based on that fact, but that's not the reason why I'm bullish. So you got to ask yourself, okay, so this is a company that can pay back its debt that quickly. What is it going to do with all of its cash after it pays back the debt? That's the question you have to ask. So remember, in the previous segment, I did show the history of what Crocs has been doing with their money. Before the HeyDude acquisition, when they racked up all that debt, the company was aggressively buying back shares. So we can see that prior to the acquisition, the management team was buying back, over the last 5 years, we see about 13% of the total float bought back, which is quite big. Considering how cheap the shares are right now, I see the shares are at a free cash flow yield of around 11%. That is insanely favorable. So the management team in the most recent quarter has already expressed that they're already doing share buybacks again for Q3 of 2023.
A little bit faster, please. I want to feel like it's raining on me, okay? You've been promoted. Switch positions.
Money.
Alright, so Q3. Earlier I said that maybe around 5 quarters to get rid of the debt. Well, that was not taking into account the share buybacks. With the buybacks, it's probably going to take maybe 2.5 more years for that debt to get back down to the proper level. All that being said, they're buying back shares, producing some shareholder value. I will say this quarter they bought back their shares at around 100-ish per share, which is probably not the best, but I'm going to assume that when we look into Q4, they'll be buying back shares for even better prices. Alright, so let's talk about the elephant in the room. Point number 3 for why people are bearish on the stock is HeyDude. I think the main point that we have to remember here is HeyDude only makes up about 1/4 of the revenue of Crocs. You know, you get this little segment of Crocs that's slowing down slightly, and the market freaks out. But then it forgets that Crocs in general, the whole brand of Crocs, is raising its revenue guidance still. Let's go ahead and crack into the numbers here. This one's going to be juicy, so stay tuned. Wholesale revenue fell about 8.4% on HeyDude. In order for me to explain this, Crocs kind of breaks down their revenue into 4 different segments. Of course, they have the Crocs brand and HeyDude, and they also have wholesale, and they also have direct to consumer. So that makes up 4 different segments. The wholesale revenue of HeyDude fell 8.4%, while the direct to consumer segment of HeyDude went up 30%. This amounts to a total, there's a slowdown in the amount of revenue that HeyDude is producing right now. But again, remember that this is only 1/4 of Crocs. I think the big point that the market is missing is this revenue slowdown is only temporary. So that was the Q2 HeyDude analysis. Let's do the Q3 HeyDude analysis. Okay, so this is honestly the main bear thesis. Let's look at the numbers first. So 3.5 to 7.5, all the way down to -4 to -6. I mean, that's pretty bad. And we have this revenue guidance for HeyDude of -20 to 25%. I mean, there's no sugarcoating it. It's pretty bad. So I want to make 3 main points about the revenue drop of HeyDude, and we'll talk about these in detail. Point number 1 is the transition from wholesale to direct to consumer. Point number 2 is excess inventory. And point number 3 is the brand value of HeyDude. As I said earlier in the revenue segment of this analysis for Crocs, there are probably some headwinds that have to do with the transition from wholesale to direct to consumer. As you can see, the wholesale has dropped significantly and the direct to consumer has gone up. And while that is exactly what the management team said they're going to do, it is still very concerning that the wholesale is dropping by this much, which is causing a drag on the whole entire company's revenue. Point number 2 is excess inventory. Just looking at the history of Crocs about 9-ish years ago, it seemed like Crocs, the original shoe, had gone through something very similar to what HeyDude is going through right now. And pretty much what ends up happening is when distribution is not tight and you start cutting out those distributors, they want to liquidate their shoes and they start selling the shoes for much less. And that undercutting really does slam into the margins. And it probably will take some time for the excess inventory to really wash out.
Unauthorized inventory levels have improved versus where they were in June. And based on our current visibility, we expect gray market goods to be in a substantially better position in the first half of 2024. While we are not guiding to 2024, we would expect HeyDude wholesale revenues in North America to remain negative through Q2, tied in part to macro and in part due to our decision to pull back on promotional activity, prioritizing brand health and marketplace management.
So for point number 2, I think the main thing I want to say is once everything is flushed out, Crocs management team will be able to control their inventory and control the brand of HeyDude once again. And perhaps at that point, we might actually see a massive increase in profitability and margins again. And the final point to explain the drop in revenue, HeyDude has simply not had enough time to prove itself yet. You see, years ago, Crocs grew its brand by its strategic partnerships. HeyDude did have one strategic partnership that we saw recently, but it's just not enough yet. Coupled with the fact that we have such a tough economic environment, people probably are not thinking to themselves, hey, let me go ahead and buy some HeyDudes when I'm strapped for cash. And that's the risk. You're betting on the management team to make HeyDude into a national and international brand, just like they did with Crocs.
Beyond this year, I would like to provide some of the building blocks on how we're thinking about HeyDude's growth agenda. First, we're adopting an omni-channel approach to drive engagement and meet consumers where they shop. In addition to strengthening our digital capabilities and staying disciplined with our strategic wholesale partners, we'll explore brand accretive opportunities. To that end, we're in the early days of developing an outlet retail strategy for the HeyDude brand, leveraging Crocs' successful retail playbook. We've opened our first outlet locations and expect to have 5 locations by the end of the year. Second, we're remaining laser focused on winning with our U.S. strategic wholesale partners. We also expect to start 2024 with a much cleaner account base, having shuttered over 50% or 600 accounts during the year. We have also pulled back on digital rights for accounts that fall outside of our strategic accounts. Third, international. We have set up a few test markets in Europe and are laying the groundwork to expand in new international markets in the next 2 to 3 years. We will use an approach that is consistent with our Crocs playbook, go direct in markets where we are direct for Crocs, and utilize distribution partners in markets where we are indirect with Crocs. With HeyDude, we're focused on protecting profitability and elevating marketplace management, even if that comes at the expense of near-term revenues, in an effort to support consistent, profitable growth on the long term.
I'll close off this segment by saying that, quite frankly, I don't like the HeyDude acquisition. In my opinion, it muddied the balance sheet, and it is very likely that they overpaid for the acquisition. Had they waited to acquire HeyDude right now, they would be paying a much better price. And with that, I only have 2 final things to say. First, if you like this video, like the video so I can become a full-time YouTuber. And second, to be or not to be. To be or not to be. To suck or not to suck. Oh, hold on. Fashion, innovation, disruption. So you want to be rich? You don't know what you're doing. So go ahead, hit that subscribe button and join me so you can achieve financial freedom with Dennis. I'll see you on the moon.